The world runs on a strange habit. Everyone complains about the dollar. Yet everyone saves in dollars. You see it every time a crisis hits. A problem starts in the United States. Banks wobble, markets shake, and somehow the fear spreads faster outside America than inside it. People in other countries panic more than Americans do. Not because they love the US, but because their savings, their trade, their debts, and their reserves are tied to one thing, the dollar. This is not loyalty, this is dependence. When the US sneezes, the rest of the world catches a fever. We have seen this before. In the early 2000s, in the global financial crisis, every time the same pattern appears, America gets hit first, but America recovers faster than everyone else. Why? Because the US can print the currency the world uses. When trouble comes, the US does not need to beg for help. It turns on the printer. Debt becomes cheaper. Old obligations are paid with new money. The rest of the world cannot do this. They earn dollars, they cannot create them. This is why global crises feel unfair. Losses are shared, but control is not. And this is where the story quietly changes. Recently, China did something that looks small on the surface, so small most people ignored it. China issued $4 billion of dollar-denominated bonds, not won, dollars. At first glance, this looks odd. China has trillions in foreign reserves. China holds hundreds of billions in US Treasuries. China does not need $4 billion. So why borrow it? Think about an ordinary person. If someone borrows a small amount of money, it is rarely because they are starving. It is usually because they are testing something. A credit line, a relationship, a market. This was not a survival move. It was a signal, and the response was louder than anyone expected. Investors did not offer $4 billion, they offered over $100 billion. More than 20 times the amount China asked for. That alone should make you pause. But the more interesting part was not demand, it was price. China borrowed at nearly the same interest rate as the United States. Let that sink in. US Treasuries are treated as the safest asset on earth. They are the benchmark, the reference point. Everything else is measured against them. China does not have that privilege. China cannot print dollars. If China defaults on dollar debt, it cannot fix it with a printer. Yet the market priced China's dollar bonds almost the same as US Treasuries. This was not charity. Markets are not kind. Markets are honest. This tells you something shifted. For decades, safety was not just about repayment. It was about liquidity, about depth, about who stands behind the system. And now, money is voting differently. This matters because interest rates are not just numbers. They are gravity. When Treasury yields rise, everything else feels heavier. Stocks struggle. Real estate slows. Risk assets lose their shine. For years, investors used Treasuries as the quiet option. No thinking, no stress. Just park money and wait. But now Treasuries are behaving strangely. The Federal Reserve has cut policy rates. Yet long-term Treasury yields stay high. Some even rise. This is not supposed to happen. Normally, rate cuts pull yields down. Cheaper money flows into bonds. Prices rise. Yields fall. But this time, something breaks the script. The US is issuing enormous amounts of debt. Trillions. Year after year. More supply. Same demand. At the same time, the Fed is shrinking its balance sheet. Pulling money out of the system instead of adding it. More bonds, less cash, prices fall, yields stay high. This is not a mystery, it is basic math. Now zoom out. China watches this carefully. China has been reducing its holdings of US Treasuries. Not by dumping them. Dumping would crash prices and hurt China too. Instead, China waits. Bonds mature. Money comes back. China does not reinvest. Quiet, slow, controlled, but there is a problem. Long-term bonds mean long waits. 30 years is a long time when money is losing value. Inflation does not need to be dramatic to hurt you. It only needs to exist. What buys 5 barrels of oil today may buy 1 in the future. So China looks for a way out, a way to recover capital without selling, without crashing markets. This is where the dollar bonds come in. China borrows dollars from the world. The world lines up. China keeps holding US debt. The US owes China, but now the world owes China. China has effectively passed the waiting to someone else. 30 years from now, the US pays China. China pays the world. The risk has been redistributed. The structure changed. The plumbing changed. No drama, no headlines, just a quiet experiment. And the data came back loud. Markets showed they are willing to treat China-issued dollar debt almost like US debt. That is not about ideology. It is about options. Money does not like being trapped. Money likes alternatives. This does not mean the dollar disappears. That story is too simple. The dollar does not need to be replaced to lose power. It only needs competition. Control of a system does not require inventing a new one. Sometimes it only requires standing between the user and the source. If countries can borrow dollars without going to the US, if investors can buy dollar assets without buying US debt, then the monopoly weakens quietly. This is why global markets feel confused right now. Stocks stall, bonds struggle, crypto swings, gold hesitates. Capital is searching, not for returns, for footing. When systems change, prices wobble, not because value disappears, but because reference points break. If you are watching this as an individual, it can feel overwhelming. Geopolitics, central banks, debt cycles. But money leaves footprints, always. You do not need to understand every speech or policy. You need to notice where money moves easily and where it resists. Assets rise when buyers outnumber sellers. They fall when sellers dominate. Everything else is storytelling layered on top. Right now, US debt faces a simple tension. It needs buyers, but buyers want compensation. The Fed cannot cut rates freely without risking inflation. The Treasury cannot stop borrowing without shutting down government. This is a box with no easy exit. China's experiment does not collapse the system. It reveals its flexibility, and flexibility is power. For individuals, this is not a call to panic. It is a call to pay attention. When systems tighten, leverage breaks first. When liquidity shrinks, forced sellers appear. Patience becomes an asset. This phase is not about quick wins. It is about positioning. History shows that monetary transitions are slow, but they reward those who stay solvent long enough to adapt. The biggest risk is not choosing the wrong asset. It is assuming the old rules will protect you forever. The world is not ending, but it is rebalancing, and rebalancing always feels uncomfortable. We are not watching the death of the dollar. We are watching the negotiation of its role. That is a quieter story, and a more important one. When money systems reach this stage, they stop behaving politely. They stop responding to announcements. They stop following expectations. People wait for interest rates to fall. They wait for relief. They wait for the old patterns to return. But systems do not care about comfort. They care about balance. Right now, the imbalance is simple. Too much debt, not enough natural buyers. For decades, global savings flowed back into US Treasuries by default. Trade surpluses became bond purchases. Reserves became loans to Washington. That loop made the system feel stable, predictable. But loops break when incentives change. When yields rise and still fail to attract buyers, it means trust alone is no longer enough. Price must do the work, and price always works eventually. This is why volatility keeps returning even when headlines feel calm. The surface looks quiet. Underneath, capital is negotiating new terms. China's move does not end anything overnight. It introduces a second door. When there is only one door, everyone queues. When there are two, behavior changes. Even if most people still use the first door, the existence of the second one matters. It limits leverage. It changes pricing. It forces competition. That is why $4 billion mattered. Not because of the size, because of the message. Money listened. This is also why central banks around the world are accumulating gold quietly, not loudly, not emotionally. Gold does not promise growth. It promises neutrality. When trust between systems becomes conditional, neutrality gains value. At the same time, private capital looks for flexibility. Assets that can move, assets that are not locked into one outcome. This is not a cycle where everything rises together. It is a cycle where selection matters. Some assets will do well simply because they are not crowded. Others will struggle because too many people depend on them behaving the same way they always have. The mistake many people make is assuming stability means safety. Stability often means consensus, and consensus breaks suddenly. Safety is not about guarantees. It is about options, having time, having liquidity, having the ability to wait when others cannot. This period rewards restraint more than prediction. You do not need to guess the future leader of the monetary system. You need to avoid being forced into decisions at the worst moment. When debt grows faster than trust, something must give. Sometimes it is price, sometimes it is structure. This time, it looks like structure is adjusting first. That adjustment will not be announced. It will be felt in borrowing costs, in currency swaps, in where capital chooses to rest overnight. By the time headlines catch up, positioning will already be done. The goal is not to outrun the system. It is to stay balanced inside it. Cycles pass. They always do. But those who survive them rarely do so by speed. They do so by staying light enough to move and patient enough to wait. Money does not change overnight. Power does not disappear in a single headline. What changes first is behavior. Where money hesitates, where it flows more carefully, where it demands better terms, that is what matters right now. If this video helped you see the system a little more clearly, take a second to support the channel. Like the video, subscribe for future episodes. Leave a comment with your yorts or questions. Different perspectives sharpen understanding. And if you know someone who has been worried about markets, debt, or where things are heading, share this video with them. Sometimes clarity is the most valuable thing you can give. Good luck moving forward. Feel free to watch other videos on the channel to connect the bigger picture. See you in the next video.